Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for May 14th, 2016. Market is bullish normal. On an annual basis, looking at weekly RSI 14, we're 57 out of 100, the higher end of neutral. On a 10-day basis, using the 10-day NDX, we are just slightly oversold at 19 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is 2.53%, so we're 0.5% away from dipping back into sideways. We're white bullish, however. Slope of the 50 is also white bullish. It's declined, but still white bullish at 0.51. ADX is a non-trending 13.6. When this gets back above 15, we'll look to see if it's bulls or bears in charge, because that is quite often a good signal for the beginning of the next trend. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is 0.975, so we are into risk off just barely. Take that score, look at the last 5,000 trading days, and find the average and the standard deviation. That allows us to compute the risk Z, which is minus 0.38. Here you see a 90-day histogram of that indicator. This is the pullback in the volatility index here, the risk index. When it's below the zero line, it's red, and that's been a dangerous time to be long and has favored sharp volatility reversals. The slight improvement here over the last couple days is a positive thing. So we're tentatively have some room to make some gains here. Blended monthly rebalancing. These are our holdings. These are the current leaders as of Friday's prices for these different ETF portfolios. In ETF2, the theoretical exposure and the model portfolio are both at 100% exposed this week. The XME position, which had gained so much, pulled back. We took the exit to preserve profit. That money is being rolled into Brazil. Just a quick look at the ETF2, the blended monthly rebalancing portfolio, everything gave back this week, with the exception of treasuries. But Latin America remains at the top with a really nice 3-month and 6-month performance. In ETF 32, everything's still above the 4-month moving average. Everything's on a buy with the exception of China. Brazil, Latin America, real estate at the very top. In the ETF Max, these are the top 40 or so out of the 1,000 member database. Metals and mining, precious metals, some Brazil, some energies, natural gas, Russia, which is also energy. These in here in the energy in Brazil with the positive 1-week performances is what makes them very interesting to us. That's why we rolled into Brazil. Steel could be interesting here with a significant 1 week and 1 month pullback after a very strong 3 months. So there may be some rebounding in that relative strength leader if possible. Metals and mining, you see here the significant pullback 1 week, 1 month. S&P 500 pullbacks in Chesapeake Energy and Freeport and Navient, and some gains here in Newfield, Martin Marietta, Amazon in the tech space, and NVIDIA in the tech space that had some momentum that deserves our attention, NVDA. Oops, sorry about that. Market health check. See how the slope of the 30 has, which had peaked up here, slope of 30 period regression line that is. was as steep as 0.7, has now slid back to just about even, and that's this black line and channel. See, the 10 is sloping down slightly. We're almost 4% off the swing high, still 12% off the swing low. Coming very close to that sideways channel is another 0.5%, which is really the bottom of this Z minus 2. River's still sloping up, but starting to flatten out. We teased a overbought condition that pulled back to oversold. Jaws of PPO were down, but have closed and are really not pointing in either direction right now. This has been 30 days of sideways chop. I take this as a favorable sign that it did not give back, half of the gains from this big climb out of the basement here. But we've had one and now two serious tests. This is the third test of this support level, so we're going to find out this week what's up. Again, I think with the political situation dominating the news, that this is likely to be the case, a continued sideways chop. I think that's why we're seeing gains in some of the other areas that had taken a backseat to the U.S. during this run-up. So things like, again, Brazil, energy, Latin America, U.S. real estate. ETF2 regional report, strength in Latin America, very little elsewhere. Mid caps in Asia less Japan doing okay. Inside the sectors, it's utilities, industrials, materials, and energy. The defensive plays the other defensive plays still have really not caught fire yet. All 10 of the indexes are on a buy signal with us 100% invested, 0% cash. The S&P at 28 is better than the globals at 25. And inside the U.S., it's mid caps, small caps, large caps, then tech. World market model, not much to choose from outside of Latin America and Brazil. Canada's not bad. Australia's not bad. Oil has been on a nice bounce. U.S. real estate looks reasonable. Everything Asia and Europe, however, looks pretty weak. ETF top 30s. This gives us the same insights as the blended monthly rebalancing looks. New gainers up here in the MLPs. Russia, Latin America, more Russia. Oil. Inside the Dow 30, IBM has climbed up to the top of the stack. Chevron is there with it. United Health given up some of its strength, along with AT&T, 3M, and Caterpillar have pulled back. Three weakest: Microsoft, Nike, and Apple. When you add Intel down here, the four bottom ones are in tech. You have to believe that the sector at some point is going to bottom and start to gain. So we'll be watching that with our owl pattern. Shift into the daily. Some signals in the channeling and overreaction. Those will be my leading candidates for intraday targets, and I'll use any money I make on them to make some gains. Lots of good auto framers to take advantage of. In the Dow, plenty of channeling and overreactions. A handful of good auto framers. You got a triple screen here in AXP, 551Ws and DuPont and McDonald's. A handful of channeling and overreactions in the ETFs. You have a triple screen in silver. So you have a channeling, a triple screen, a 551W, and a 2.4 to 1 in silver. That's got to be on your short list for tactical trading. For those in the chat room, on the intraday trade, the collapse in XIV and the big gains in the last afternoon of the session there, in the second half of the session, VXX, was some storm clouds for this week ahead. So I'm looking for a wobbly week opening on Monday. Plenty to choose from here in the auto framer. Some of our favorite symbols in there. And in the regression line fractals, the top shelf, the ones in the green here, the ones most ATR below their own RL270, these are the deep discounted ones. You see it's dominated by the techs. And then the ones in red, the ones the overheated, the ones that are most ATRs above their own RL270, the ones leading the way. And daily squeezes for, here we're looking for 1 day pops where mechanical entries with a range risk still give us very favorable reward to risk ratios. SanDisk is one that would be of interest. In the market mosaic, the parabolic regression line has rolled over, closed weekly Thursday and Friday. The slope of the 30-day regression line has come all the way back to the 6-month average. It's managed to do this without serious collapse, although we're getting ready to test this 205, and if that fails, down she goes, and it'll be back toward another 5% off the top. Here you can see volatility has just snuck back up into normal, the very low end of normal. We're even back at the baseline looking at the 10-year averages too. So absolutely normal conditions. Here we have the z-scores of the regression lines. So it's holding nicely here at the bottom of the river. The 10 has come back up into normal, right at that mean. The 30 is pulled back into the mean. The 90 is still steaming northward. So the 90-day trend, over the last quarter, this was a terrific quarter, and this just looks like digesting at this triple low. And that's everything I wanted to cover from this week. Lots to choose from. We're going to keep our risk measured and our powder dry, and continue to work the intraday trades while we're so close to that key support level around the 200-day moving average, taking advantage of intraday volatility, which, to be fair, has not been all that large as you look at the fact that we just moved into bullish normal. So even with that relatively low volatility, we've still been working pretty hard and making some gains. So, Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.